Good morning, everybody. I'm Marc Loomes, the CEO of ECO, and I'm joined by Chris Wilks, the CFO. Our intention today is to walk you through our interim results for the period ending the 30th of September of this year, but to highlight a number of themes, notably around the pork market volatility in China, the performance of the business in the rest of the world in the face of a number of supply chain disruptions, to spend a little time talking about cash, and then to focus in on the potential of our research and development program before we move on to questions in the latter part of the webinar. So at this point, I'd like to hand you over to Chris, who will begin talking us through the numbers.
Thank you, Mark. I'm delighted to be able to present to you today. We'll take a little bit of time, perhaps to step back into some understanding points, which is, I think, important if you're new to the ECO story, new to the stock, and to therefore help to explain how the numbers arise. The financial highlights are fairly self-evident. They're clearly set out in the release. The one point I'd like to make at this point on this slide is to explain the gross margin change, 48% in the 6 months ended September 2020, down to 46% this period. The reason for that is it flows directly from the mix of sales. We operate in 14 different countries around the world, and each of those markets is represented by different species and different market routines. That results in a spread of gross margin reported from those markets. Some markets, such as Canada and China, are high margin markets. Canada operating typically at around 60%, and China operating around 55%. Conversely, there are some markets within, for example, Latin America, where the margins, gross margins, are down in the 30s. So clearly, you can see from that the overall average gross margin for the group will vary dependent upon the component of each of those markets that represents the whole. We'll talk about EBITDA and the profitability bridge as we go through the presentation. Clearly, there'll be a lot about revenue and the different markets in which we operate. And if we could flick over to the next slide, please. We'll also, as Mark said, talk about cash generation and where that cash resides. And new product development will be clearly an important element of what we speak about. To pick up the cash piece straight off the bat, the cash, a high proportion of our overall consolidated cash position is currently in China. The China business is operated as joint venture. The ECO Group holds 51% of that joint venture. Therefore, it follows that is a subsidiary, and we consolidate 100% of the profit loss account and 100% of the balance sheet into our numbers. The net result is that the cash is the total value of cash wherever it's held in the group. But the repatriation mechanism for cash from China is by a dividend, and when that joint venture declares a dividend, obviously 49% of it is then distributed to the JV partners. So it's always important when you consider cash in the ECO Group you can pro forma out the minority portion of that cash, and that's an important point to note. There is a further point to note on cash balances, and that is the sort of day-to-day cash balances available to the group here in the UK, i.e. not trapped in China, because anybody who's observed China, you'll observe that it's actually quite difficult and inefficient to repatriate cash from China, and therefore the day-to-day cash is really that cash that is not in China. That said, we are about to receive £2.1 million from China this week, and we'll be receiving a further 1.6 by the end of this calendar year. Both those relating back to 2020's profitability, and then 2021's profitability will be distributed to the UK during the course of next calendar year. Next slide, please, Hannah. Operationally, there are several highlights in here, which we'll talk about as we go through the next couple of slides. Revenues in Southeast Asia have been particularly strong. We've clearly had the decline in revenue in China, which we'll describe in some detail. But I think the important thing to note as a highlight is that whilst much of the story today will be about China and the extreme cycle that we've just been through, but outside of that, the group's revenues have increased by 5% in aggregate, and that growth is predicted to continue. For the full year, we're expecting 10% growth year on year, which is on the long-term trend line for Eco Group. We've also had some great results in our vaccine trials, and we'll speak more about that when we get to the R&D slides. Hannah, next slide, please. So segmentally, the segmental analysis is in the release. This is just setting it out in a graphical format. Clearly, the China revenue has come off compared with the first half last year. First half last year was the first half of an extraordinary year. The recovery in China from African swine fever, which first impacted that market in 2019, was, I think, by most observers' comments, an extraordinary recovery, much faster than was expected. A rapid restocking of the herd in China, and the resulting in oversupply and an overshoot, and that's resulted in the softness of trade during the course of this year. That softness in China was seen through the summer months. The pork price fell through the spring and into the summer, and we recorded revenue of Avicen, which is our branded product. That revenue fell from April through May through June. It hit a low point in July. At that point, we were thinking, well, it's come off from such a high point, nothing too much to be concerned about. And the summer period is a seasonally low demand period for Avicen being used to treat those diseases which typically arise in the winter months. But when the August arrived, we recorded increased revenue compared with July, and September was an increase in August. And so we felt that this was a position which was readjusting. October, on the other hand, the pork price fell back sharply, and our revenues in that month fell accordingly. So we are now adopting quite a cautious outlook for China for the full year, and expecting no second half weighting in that market. North America has been a strong trading period. That green line representing the revenue for the first 6 months in 2021 would have actually been higher than is set out on the page there, had it not been for the fact that supply chain inefficiency and disruption had caused us to be delivering product some 4 to 6 weeks late on to customers, and that slightly softened the revenue we recorded in 6 months. Since September, October was very strong in the US, and November too. Both those months beating forecasts, beating budgets, and therefore we're confident of a very strong result for North America in the full year. South and Southeast Asia is a segment which is dominated in this period by Thailand. It represents all of those countries in that Southeast Asia quarter, some of them bordering China, as well as India, which is the South Asia element. Thailand has been a strong performer this year. We talked a little bit about it in the release, and it's been a model territory for us, and been strong because we've got very good eco-employed sales leadership on the ground, combining with a stocking distributor who is very effective in country. Latin America, dominated by Brazil and Mexico, and then a basket of other countries such as Cuba, Argentina, and it's been a very strong trading period for Brazil. This is a continuation of growth in that market, and improving margins as well, which supports it. Europe, it has been characterized in these 6 months with some post Brexit, and in particular the post-transitionary period, and the difficulties in relation to supplies, logistics, shipping in a regulated product into the continent. Nevertheless, we've worked hard on those mechanisms, and they are now correcting themselves. We expect stronger results in the second half in Europe. We'll move on now. Hannah, please. This next slide adds a little to that same story by adding in another 6 months, and you can see some trend lines within that when you're looking at four successive periods. In particular, in China, you can see that when you read across from the pale green line to the white line, you're straddling the ASF period. African swine fever hits during 2019, reduced revenue in that pale blue line, recovery in the gold line, and then this year's white line. So you can see the compressed nature of that particular cycle. And actually, if you go back in time, you can see that the trend line of growth there within China exists. Similarly, the South and Southeast Asia pale blue line is a one-off event when we appointed a new distributor in India for the poultry market there, and that was a period of stocking up that distributor with Avlison. Taking that out, you can see the sort of trend line of improvement. The bottom graph on this slide really just serves to demonstrate the second half weighting, which is evident in our revenue right back in time, and that is a seasonal effect associated with disease outbreak. But you can also see the impact of the China trading during 2021, which has sort of skewed the graph upwards. Excluding that, you can see that we are really on trend for an H1 result. Thank you, Hannah. This next chart serves to represent the P&L in a profit bridge format, and the only point of significance I'd mention at this time is the new item this period, which is the impairment of intangibles. This links across to the R&D story, which we'll talk about later on, but suffice to say at this point that the excellent results we had from some of our vaccine trials meant that we took a critical look at some of the legacy projects those legacy projects relates to a parasite treatment for horses for the equine market. It's a non-core area for Eco, and it's been a project which has been around for a long time. There was a requirement to do some ecotoxicity work in this area to bring the product through to commercialization. When we reassessed the business model on this, it was no longer as attractive as some of the other projects in the pipeline, and therefore we decided to cease work and accordingly impaired the previously capitalized costs in this area. Hannah? The balance sheet more or less speaks for itself. The important point to note here is the comments I made earlier about inefficiency in the supply chains has shown up as an inventory build. So you'll see that the inventory has increased by about £6 million from March to the end of September. And that is shown in the stock days lengthening. We believe we are now up over the top of that particular hill. We've reached the plateau with the increased supply chain time from origin to market being baked into these numbers. The effect of that is of course a cash tied up in that inventory, which we've spoken about. The cash flow forecast on the next slide really just shows the working capital movements from that balance sheet. The point to note here is I think a demonstration of our particular business model. Eco has an outsourced model. So aside from China, where we actually do have a factory, everywhere else we subcontract the manufacturing of the product. We subcontract our R&D. So we collaborate with laboratories, but we don't own those laboratories. And so as a result, we're not capital intensive in a capex sense. So you'll see the sort of capital expenditure lines at the bottom quite low. So the cash flow statement for Eco is essentially the profitability generated from trading, dropping through working capital movements to cash balance, and that's the way to think about Eco. Eco is also, because of the outsourced nature of the business, fairly fixed overhead structure, and so the revenue changes at the top line drop pretty much straight to the bottom line. Another point to note when it comes to R&D, our rule of thumb for R&D expenditure in any particular year is to spend around about 10% of revenue in those programs, and that is an important balance because it means we can both fund the R&D program from our cash flow without obtaining external funding, but secondly, we can fund our R&D program sufficiently to move those programs along to commercialization at the target time. Thank you, Hannah.
The following slide serves to place the information that Chris has provided this morning into a context over a period of 2 years and 3 months. Going back in time to August 2019, African swine fever, a viral disease which kills pigs, swept through China over a number of months, dramatically altering both the level of pork production and the way pork was produced in China. It's hard to comprehend the numbers, but half the national herd disappeared. A quarter of the world's pigs disappeared from China during this period. And as a result of this very tight supply of pork to the Chinese market, prices were driven up to a record level of 38 RMB per kilogram by November 2019. At this point, the Chinese pork price was running at about 4 to 5 times the global reference prices, notably looking at the USA and possibly Spain as a European comparator. Record profits were being made during 2020, and clearly when there are record profits to be made, a massive influx and investment took place in the industry, with the recovery of the sow herd progressing very rapidly by taking low-value commercial female pigs that normally would have been sent to the slaughterhouses and putting them in the breeding sheds to drive up numbers very swiftly. During this period of disruption, the market fundamentals changed in that the backyard segment, which had been highly prevalent in China, of a couple of pigs in a village or owned by individual farmers, moved the dial dramatically towards what we would consider super producers or key accounts, commensurate with what has happened in most of the Western industrialized pork producing nations. However, this rapid swing back into production and oversupply dovetailed in with COVID-19 and a further outbreak of African swine fever. This one, unfortunately, being triggered by fairly naive producers in some cases, trying to prevent the disease by using unlicensed live vaccines, which in fact, rather than curing or preventing African swine fever, triggered another outbreak. This resulted in a collapse of the pork price to 10 RMB by October, where losses of up to $200 per head were now being sustained. Clearly, a $400 per unit sent to market swing is going to curtail investment, with the sow herd being liquidated once again in order to cut import costs. And sows were being sent to market at 2 RMB per kilogram. So if you can conceive of 38 down to 10 and your most valuable breeding animals being sent to market at 2, there are considerable disruptors in the marketplace at this point. While this has all been occurring in the background, the market had segmented further. A top 20 industrialized, progressive, modern pig producers, an emerging class shaking their tails and eager to move up the rankings, and almost a washing away of the backyard segment. Over the past 4 to 5 weeks, we've seen the share price pick up. Sorry, not the share price, the pork price pick up to 18 RMB per kilogram, off the bottom of 10. This is important because at this point, producers are beginning to make some profit. We have 2 types of producers now in China: those that buy piglets in at great cost, and they have been sustaining losses for about 9 months because piglets were such a scarce commodity in face of record profits. The other category bred their own piglets, and they have been making losses for about a quarter. The industry, on average, is now moving into a period of profitability. If we cast our minds back away from the super cycle to 4 or 5 years ago, Chinese pig producers were making money at 15. Now, in the face of debt to be serviced and high feed costs, the threshold appears to be around about 18 to 20 RMB per kilogram. If we were then to take a look at slide 12, this represents the seminal events and indices in a graphic form. You can see top left how we track pork prices over the past 15 months, green being China, red dots the trend line with reference USA and Spain in various hues of blue. 50 cents, US cents, plays about $2.50 when the calculations are done. Top right, we see piglet supply versus piglet price on the right-hand axis, and below an indication of what has happened to the Chinese sow herd. At this point, we would like to move on away from the Chinese volatility, although we do believe that this is cyclical. There are early signs of a recovery. It will be modest, it will be steady, and it will play to ECO's global key customer base. Ableson, our flagship product, which we've reached this point without even mentioning, is very much a respiratory disease. And as you'll know, respiratory diseases are more prevalent in the winter months. In China, Ableson is positioned as a high-value premium drug for respiratory disease in sows and breeding females. So as the herds are rebuilt, it's winter, we anticipate a gradual improvement in the revenue profile of Ableson over the next 4 to 5 months. We've seen that through November's flash. Indications for December are better than November. So we feel that we've come through the trough and we're moving forward as we would like, but at a more muted pace than the very exuberant first quarter of 2021, where the market was at its absolute peak. The next area of the business we would like to share with you in some detail is our R&D, where we have invested heavily in the development of a vaccine or biologicals portfolio to complement our best-selling drug, Ableson. There's a lot of detail on this slide, and I don't intend to go through it in much detail, other than to say these are the rigorous stage gates that each project needs to pass through, from discovery through to full development, submission, and regulatory approval. Each stage gate is accompanied by a decision of go, no go, based on financials, the probability of technical and regulatory success. The timelines are captured there, and the costs. They start off modestly, but only as we enter full development, where there's a confidence that this biological or drug, Ableson, will reach full commercial deployment, does the expenditure ramp up. If you were to look at our R&D portfolio currently, we can segment it right down the division between green, the research phase, where expenses are put through the P&L, and blue, the development phase. Think Ableson, we're in development for the last 4 or 5 major projects before we begin to life cycle Ableson, invest only in small niche projects and maintain the licenses. Whereas our biologicals development program, which we will continue on the next slide, is very much in the green research phase and is beginning for the most advanced projects to enter full development, which, as I've indicated, is that point where we become relatively sure that this is a product that will be marketed and generate a significant return for the business. Turning now to the next slide, where we have an R&D update, just to remind you that our focus of the pipeline is very much on our core species, pigs and poultry. We are interested in treating with Ableson and preventing with vaccines bacterial and viral diseases of the respiratory and gastrointestinal systems only, because these are the diseases of economic importance. Looking to our portfolio, we do have a mix of early, mid, and late stage projects, so running from left to right across the schematic we've just looked at. Some are fairly conservative in that they're never going to break fresh ground, but we do have a mix of these type of concepts and novel disruptive technologies. We are constantly refreshing the portfolio in that projects fail or are eliminated because they are replaced by better ones as we move from left to right through the model. But our intention is to have up to 20 active projects at any one time, recognizing attrition will occur. We've spoken about the Ableson projects, the 5 that are being driven through the model currently and are very much to the right towards the tail end of the development cycle. The remainder are vaccines. And revenue from these vaccines, the first vaccines, are expected from around about 2023, which takes us right down to that tiny little box on the third column, fourth square. Poultry mycoplasma vaccines have progressed to late stage development. This is something of an understatement because our first foray into vaccines was hiring a formidable team of experts in developing vaccines from our class competitors. They had collectively more than 40 years experience of doing this. And post our first announcement to the city that we had formed a collaboration with the University of Georgia to develop poultry vaccines, we now have 2 entering late-stage development. As I've said, we expect to launch them in 2023 and roll them out globally. But to that end, we have also hired a global vaccine poultry specialist from a European competitor to review our business cases, look at the positioning of our vaccines to come and how they might best fit with Ableson. So we go all the way back to the focus on treatment and prevention. Treatment, Ableson, prevention with vaccines of diseases of economic importance for pigs and poultry. The following slide spends a little time talking about the importance to governance to ECO, our corporate responsibility report, our first one produced for the March 2021 annual report, and we're continuing to work on our ESG credentials. ECO's been on a considerable journey of corporate governance over the past 3 or 4 years, as some of you who followed our story may have noticed. We feel that the business is in excellent shape at the moment. What has helped enormously has been our focus on Ableson as an antibiotic, which I need to digress slightly into the fact that it is an epitome of what you would desire from a modern antimicrobial. And because we're focused on improving the health and welfare of animals, through the UN Sustainable Development Goals, we tick a number of boxes, which we will continue to elaborate on when we look at the 3 basic requirements for producing protein of animal origin healthily, which are management, including nutrition, vaccines, which we are developing, and treatments, which we have through Ableson. On cue, Hannah will hit the forward button and an icon will pop up, just reflecting what I've had to say before we move on to the next slide, which also links back to ESG. We have recently been awarded a Green Economy Mark from the LSE and are taking cybersecurity as a company that is involved in pharmaceuticals and animal health very, very seriously, being awarded the Cyber Essentials certification. So what we do is secure and cannot be hacked or stolen by any competitor or someone with an agenda. We are preparing diversity matrices and initiating discussions with a number of external consultants for our climate change commitments for reporting at the next annual report. We're now moving into the tail end of the presentation, which really links back to what has been the hallmark of our business through the past, well, it seems forever, but it has only been from March 2020, COVID-19, overlaid by African swine fever. We have become remarkably efficient at our staff working with our customers and our third-party distributors, because although we have 14 offices in the markets that produce food today and tomorrow, we do sell through a network of third-party distribution in another 60-odd countries. So we have learned how to reach them through online conferencing, podcasts, leveraging existing relationships. And as an early mover into this area, we are seeing the rewards when we look at the rest of world sales patterns through the first half and our anticipation for the year end. We are returning to gradual and measured face-to-face meetings. The other matter I'm not going to dwell on because Chris has touched on it in his review of the numbers, and you'll be familiar with this across a number of industries and possibly even in your own businesses, the complicated, costly and global supply chains, which have impacted on inventory, 6 million up, and our ability to service customer demand as slickly as we would have wanted in the past. But we're working on this and feel confident we will unwind the few countries where we have back orders in the next couple of months. Moving to the last couple of conclusions, at the risk of laboring the point, China will move through the super cycle. If you're unkind, you may consider it to be, or blunt, someone like me, you may just call it a bust, boom, bust cycle. But the Chinese authorities are aware that pork is a strategically important protein. It's important politically, socially, economically to China. And this hyper excitability will stabilize, and we will resume the steady 10% year-on-year growth that we've been accustomed for the past 13 or 14 years across the business. South and Southeast Asia are the standout performances. Thailand is going to be a star market for ICA. Excellent local distribution partner, boosted by eco staff on the ground, servicing the food producers, a model that we've actually followed to great effect in Brazil. Once again, stellar third-party distribution, Eco Brazil leading and supporting them. The USA, the apparent weakness at the end of September really was a reflection of revenue cutoff points and delayed shipments into the customers. We are not alone there. All our competitors are facing exactly the same challenges, very strong post-period trading in that market. And of course, looking to the future, our investment in our R&D portfolio continues apace. We've gained a number of important approvals for Abrison. We have another 4 major files under review in China, 2 of them, 1 for pigs, 1 for poultry, 1 in Canada, 1 in the USA. The first vaccine in Brazil has entered commercial deployment, and our poultry mycoplasma vaccines have entered late-stage development, commercialization during the course of 2023. So the business looks forward to the future with a degree of confidence.
Thank you very much, Mark and Chris. A very helpful canter through, and we have a couple of questions. Is the surge in Thailand revenues the result of cyclical factors or more sustainable factors such as adoption growth or market share gains?
Thailand is a recovery from COVID-19 and African swine fever, which spilt out over the borders into Thailand. It has the benefit of being both a pig market and a poultry market, with, as I said, a really strong national distributor. And this is about gaining market share from competition. It is not a rebasing. Our view is that Thailand potentially has the ability, with Abrison alone, to be a $10 million market for Eco. So there's considerable penetration and market share gains still to be gained. Too many gains, sorry. Market share to be won.
Thank you. You touched on at the end there that the pig market was too important to the Chinese authorities for continued boom and bust. Can you expand on what measures they are taking to try and smooth those cycles?
They've intervened in the market twice in the past 9 months in the period of decline in a very modest way. There is a magical number at which the Chinese authorities appear to intervene, and that is when the ratio of the pork price to the feed price dips below 5. So it is discrete support whilst the market stabilizes. What China will need to do at some point in the future, and they don't appear to be doing it yet, is to bolster the significant national reserves of frozen pork. In the African swine fever pandemic, the tightness of supply was such that at the provincial level and at the governmental level, frozen pork reserves were liquidated. This will, at some point, further stimulate demand, but for now, it's a light touch, possibly providing some support, financial support, to the major integrators, the top 10 super customers, in a similar way that the Russian authorities did in Russia in the face of African swine fever, as Russia sought to become a progressive, modern, independent, globally independent producer of pork.
Okay. How does your Chinese JV partner feel about having so much of its own cash trapped in the JV? Is there an opportunity loss for them, which they are feeling acutely?
Chris, would you like to take that one?
I'd be delighted. Our JV partner is a company which is called Huge Leaf. It's a listed company in Shanghai and has a number of interests in the animal health space as well as in other unrelated industries. They, like us, clearly benefit from the distribution that the joint venture makes, and they, like us, look forward to that distribution when it happens on an annual basis. They're a larger company, and this is an investment within their portfolio, so they're not hurting by not receiving the dividend until now, but they will be receiving that, like us, by the end of the year.
Okay, and then perhaps leading on from that, what costs does ECO incur in repatriating dividends from the Chinese JV?
That's a good one, and I could spend the rest of our time available by giving you a talk about China tax. Suffice to say, the various mechanisms available to international companies to repatriate cash from China vary from service agreements and royalty agreements through to dividends. The Chinese government doesn't like service agreements or royalty agreements. They're considered to be uncontrollable and can result in leakage of currency out of the country. And so it's structured the tax system to urge international companies to use the dividend mechanism. Dividends are repatriated out of post-tax profits. The tax rate, the headline tax rate in China is 25%, and the dividend is subject to a 5% withholding tax. Contrast that with a royalty mechanism where the amount you receive in internationally in the UK is some 59p in the pound. So you can see the effective tax rate on royalties is much, much higher, and the effective repatriation is much, much lower. So hence we are going towards dividends as being the mechanism that we use.
Okay, well, again, this one probably leads on. Given the distortions to cash flow from consolidating the Chinese JV, And with the limits on dividend distribution in mind, is there a case for presenting this investment as a related company rather than a full consolidation?
There is, and that's gosh, that must be an accountant who's posed that question. It's the accounting rules essentially on whether you consolidate are around share ownership and therefore control. The assessment of that joint venture is very much that we ECO control it, and therefore it is a subsidiary. That said, our representation or presentation of the cash in two parts, the consolidated position and then illuminating the amount held in China, is a step in that direction to just showing what the situation would be if we didn't equity account for it. So in due course, that may be something that we show in a pro forma basis on a non-consolidated basis, but for now we follow the accounting rules.
Okay, but back to you, Mark. I think is there a danger that the vaccines will cannibalize traditional treatment?
Thank you. A very good question. We had seen the vaccines as being an ability to offer a broader portfolio to our customers. It is remarkable that ECO has delivered numbers from Abelson when, after all, we have a single flagship product and a very limited support range. The name of the game today in animal health is the strength of your portfolio. So that is a driver. The other two drivers are, if we look at disease, there are ways of preventing it from vaccines, and there are ways of treating it with Abelson. And the two are highly complementary. No vaccine is entirely 100% efficacious, and they also have immunity that has limited duration. We will know from possibly our own experiences that very young animals or people don't respond particularly well to vaccines. And as you get older, you need boosters to keep your immunity levels high. The final consideration is that all of our Abelson sales have been into animals that are vaccinated. They've been vaccinated against a number of diseases that we are developing vaccines to. So we want, to put it fairly crudely, a piece of that action. The biologicals, the vaccines, have much better margins at the gross margin level than do pharmaceuticals. If we're thinking Abelson as an antimicrobial, topping 50% gross margin is quite an achievement. If we were to think of a biologicals range, we would be thinking gross margins in the order of 60 to 80%. So there are a number of compelling reasons why ECO has moved into the biological space.
Well, perhaps then following on from that, obviously we touched in today's presentation on all the challenges that you're facing in China, which I'm sure is going to answer part of this question. I would also point out that we have today published a brief comment on the results, but we will be producing forecasts, detailed forecasts in the coming months. So, gentlemen, any comment that you would like to make on the share price drop, from £6 to sort of 140, 150 in the last couple of years, when, as this gentleman sees it, or lady, the business is growing substantially turnover-wise and is, in essence, more profitable?
Probably best that Chris takes that one as a newbie to the business, having been in the hot seat for 2 years, whereas, you know, I'm an old hand in all senses of the word.
Yeah, never mind the old Mark. I think, you know, hard to comment on what was fundamentally supporting the historical share price, but needless to say, when this whole governance improvement started a little over 2 years ago, it started with reassessing the way that the accounts were structured and the way that we were presenting our results. And one of the adjustments to the way that things were accounted for was around capitalization of R&D. And even a cursory glance back at the accounts 2 years ago showed that we put through quite a sharp change in that approach, which had the headline effect of reducing profitability. That was a non-cash adjustment. It was a paper adjustment, but nevertheless took our profitability down, and that adjusted the share price as a consequence. Where we are now, I would say the share price clearly has reacted to these half-year results. I don't know whether I'm allowed to say it's overreacted. That would be purely a personal opinion. But I think one thing is very clear to us is that the share price, as it currently stands, is low compared with the peer group, and therefore does not appear to bake in any value for the pipeline of opportunity we've got coming through this R&D program. And so we're looking forward to describing more of that R&D program in the new year, and we're planning a Capital Markets Day, which will be focused very much around the R&D program. It will be showcasing what we're doing there, and we will be trying to, I suppose, show to the market where some of that intrinsic value is within Eco. There's a very well understood piece of research, which is that 50% of a company's share price tends to have nothing to do with the company. It's about global economics, and a further 25% of companies' share prices typically only to do with the sector in which the company operates, leaving 25% to do with the company itself. It's very well understood research. I think we have been affected by China commodity price cycle, which our ability to influence is low, and our job is really to try and diversify some of that risk and to ensure that the rest of the world markets are correspondingly strong when China is weak.
Good overview, thank you, Chris. Back to the growth opportunities. Is there any appetite from yourselves and your JV partner to invest cash in China, perhaps with a new factory?
Good question. Yeah.
So that one, we are investing in a new factory in China, and plenty of cash there, obviously, to do that. There is some regulatory change which is requiring products like ours to be manufactured in a more automated fashion. So there is a new factory which is being built as we speak, and it goes live in the late spring of next year. So that is a current program.
Okay. Well, thank you very much for your time. That is it from the questions. I don't know if you have any closing comments you'd like to make, Marc.
Hannah, thank you, and to Equity Development for bringing us to this forum. This will be the very first time we've engaged with retail investors in a platform such as this. But I can assure you, under Hannah's direction and with our support, it will not be the last. So thank you very much for your attendance, and we look forward to doing this engagement on a more regular basis in the future.
Thank you, gentlemen, and thank you to everyone for joining us. Bye-bye.
Thank you.